All right, so you asked for it, and we're diving deep today into consolidated tax returns for corporations. It's uh, definitely a meaty topic.
Oh, absolutely. It's complex, but really crucial for understanding how larger corporate groups handle their taxes. It's not just, ticking a different box.
Right, exactly. It's way more than that. So the plan is we're going to use the material you sent over sort of our map for this and really unpack it. We
Mm.
want to get to the heart of, what is it, who can actually do it, who can't.
The pros and cons, definitely.
Yes. The advantages, the disadvantages, because there are definitely both.
Yeah.
And then walk through how they actually calculate the final number, sort of
Yeah.
cut through the noise, right?
That's the goal. Give you the key takeaways straight from the info we have here, a clear picture.
Perfect. So let's jump right in. The source material right off the bat calls filing consolidated a privilege, not a right.
That word privilege is really important, isn't it? It tells you straight away this isn't automatic.
Yeah, it implies conditions, rules.
Exactly. It's granted, not guaranteed. And the very first condition is fundamental. Every single eligible corporation in the group has to consent.
Consent. Okay. How does that work practically? Is it like a big signing ceremony?
Not quite. There is a specific form, Form 1122, the authorization and consent form. Subsidiaries can file that.
Okay, so that's the formal way.
It is, but the material points out something really practical. The very act of filing the consolidated return, if it includes all the members properly, well, that itself is usually seen as satisfying the consent requirement.
So joining the party is giving consent, basically.
In essence, yes. It's a deemed consent by participating. Though, using Form 1122, especially the first year, is probably the belt and suspenders approach.
Makes sense. Cover your bases. Now, this decision, this election to file consolidated, you can't just decide on a whim, right? There's a deadline.
Absolutely critical point. The election, whether it's filing the return or getting those Forms 1122 in, has to happen by the extended due date of the parent corporation's tax return for that year.
So everything keys off the parent company's tax cycle. You miss that deadline.
You miss your chance for that year. You'd have to wait until the next tax year to try and elect.
Got it. Okay. So it's a privilege, needs consent, has a strict deadline. And you mentioned eligible corporations. The material also lists specific types of companies that are just out. They can't get this privilege.
That's right. It's a specific list. We're talking S corporations, foreign corporations.
Okay, so no mixing S Corp and C Corp in a consolidated return.
Correct. Also, most REITs, real estate investment trusts, are excluded, some kinds of insurance companies, and most tax-exempt organizations.
That's quite a few exclusions. Why is knowing that list so important?
Because it shows the boundaries. You might have, say, a U.S. parent owning 100% of a foreign subsidiary. Ownership looks right, but no foreign core means no consolidation for U.S. federal purposes.
So the type of entity matters just as much as the ownership structure.
Exactly. It keeps the consolidated regime focused mainly on groups of domestic C corporations.
Okay, that clarifies the boundaries. Now let's get to the core. Who is eligible? What makes up an affiliated group that can potentially get this privilege?
This is the absolute bedrock definition. An affiliated group, according to the source material, is basically a chain of corporations linked by stock ownership, all starting from one common parent corporation.
A common parent. And it's not just any ownership link, is it? There's a specific high threshold test.
Very specific, and it's got two parts. For each subsidiary directly owned, the parent corporation must own stock possessing at least 80% of the total voting power.
80% voting power.
And at least 80% of the total value of all the outstanding stock. Both tests have to be met.
80% of vote and 80% of value. Directly owned. For every link down from the parent.
That's the essence of it. Direct ownership, meeting both those 80% hurdles. It's about substantial control and economic interest.
So if parent A owns 85% of sub B's vote and value, and sub B owns, say, 90% of sub C's vote and value,
then A, B, and C could form an affiliated group. A is the parent, A meets the test for B, B meets the test for C, the chain works.
that seems straightforward enough for a chain. But the material also makes a point about structures that look similar but don't qualify. This brings up brother-sister corporations.
Yes, this is a really crucial distinction, and the example they give helps illustrate it perfectly. Brother-sister means you have two or more corporations owned by the same person, but that owner is usually an individual, not another corporation.
Okay, let's use that example from the source. Say an individual, Olinto, owns 100% of Corporation A and 100% of Corporation B. Why can't A and B file consolidated? They're totally linked through Alento.
Because the definition of an affiliated group hinges on having a common corporate parent meeting, that 80/80 test. In the Alento case, the common owner is an individual.
Ah, so A isn't owned 80% by another corporation, and neither is B.
Exactly. Alento owns A, Alento owns B. There's no corporation acting as the parent owning stock in both. So, despite that 100% common individual ownership, A and B are not an affiliated group for consolidated return purposes. They'd have to file separate returns.
That's the key difference then. The parent at the top must be a corporation itself. Individual ownership doesn't start the chain.
You've got it. Now, let's contrast that with the other example the source gives, the one that does qualify. Here we have Corporation A owning 100% of B and 100% of C.
Okay, so A is clearly the common corporate parent for B and C, meets the test.
Right. And then it adds another layer. B and C together own corporation. B owns 60% of D, and C owns 40% of D.
So wait, neither B nor C individually owns 80% of D? How does D get included?
Because B and C are already members of the affiliated group headed by A, the rules allow you to aggregate the ownership of group members. Since B and C together own 100%, 60% plus 40% of D.
Ah, so their combined ownership counts because they're part of the A group.
Precisely. Because B and C are members, their collective ownership of D satisfies the 80/80 test for the group. So the sources A, B, C, and D can all file a single consolidated return with A as the common parent.
That really clarifies it. The ownership has to flow down from a corporate parent and can include subsidiaries owned collectively by other members. Okay, structure sorted. Now the big why. Why would companies sign up for all this complexity? The advantages must be pretty significant.
They really are. The source lays out several compelling reasons, and probably the number one driver is the ability to offset losses between members.
Offsetting losses, how does that work?
It's incredibly powerful. If one company in the group has capital losses, those can be used to offset capital gains realized by another member in the same year.
Okay, netting out capital gains and losses across the group.
Right. And even more commonly, if one member has a net operating loss, an NOL.
Like just regular business losses exceeding income.
Exactly. That NOL can be used immediately to reduce the taxable operating profits of other members within the group in that same tax year.
Wow. So instead of a struggling subsidiary having to wait years, maybe, to use its own loss carry forward.
Its losses can provide immediate tax relief to the profitable parts of the group right now. It reduces the overall tax bill for the entire group.
That's a huge cash flow advantage. Does it work for old losses too?
Yes, the source mentions that too. NOLs that a corporation had before it joined the group from a separate return year can often be brought in and used against the consolidated group's income, though there are specific rules and potential limitations on that.
Still, the ability to pool current losses is massive. What else?
Another really big one is the treatment of intercompany dividends. Dividends paid by one member of the group to another member.
Like from a subsidiary up to the parent.
Exactly. Those dividends are 100% eliminated when calculating the consolidated income.
Eliminated. Not just partially deducted like with a normal dividends received deduction, DRD.
Correct. If they filed separately, the parent might get a DRD, maybe 50%, 65%, or 100%, depending on ownership. But in consolidation, if it's a dividend from one member to another, it just disappears from the income calculation entirely.
So no tax whatsoever on money moving between group members as dividends.
Right. It prevents taxing the same earnings multiple times as they flow up the corporate chain within the group. Big simplification, big tax saving.
Makes perfect sense. What about other deductions or credits? Can consolidation help there?
It often can. The source points out that many deductions and credits have limitations based on taxable income or tax liability. Think charitable contributions, maybe certain R&D credits.
Right, often limited to a percentage of income.
Exactly. If you calculate those limits separately for each company, a company with low income might not get to use its full deduction or credit, but file consolidated.
And the limit is based on the group's total income or tax.
Precisely. Since the group's combined income is usually much larger, the limitation is higher, potentially allowing the group to use the full amount of the deduction or credit generated by any member. Better utilization overall.
So pooling income helps maximize those kinds of deductions. Anything else on the plus side?
One more key advantage mentioned is the deferral of income on certain intercompany sales.
Deferring income. Like if one member sells something to another.
Yes, particularly things like inventory or assets. If member A sells an asset to member B at a gain, That gain isn't taxed immediately, it gets deferred.
Deferred until when?
Until that asset or inventory eventually leaves the group, like when member B sells it to an outside customer, or sometimes when other specific triggering events happen.
Okay, so the group doesn't pay tax on profits it makes just by shuffling things internally. Tax is only triggered when value is realized from the outside world.
That's the idea. It treats the group more like a single economic unit for those internal transactions.
Okay, so summing up the good stuff. Offsetting losses for immediate benefit, wiping out tax on internal dividends, potentially getting more mileage out of deductions and credits, using prior losses, and deferring internal gains. Those are really strong financial arguments for consolidating.
They absolutely are. But, as always in tax.
There's always a but. What's the flip side? What are the major disadvantages the source highlights?
And they are significant. The first one the source flags is just the sheer complexity of the regulations you have to follow.
The dreaded complex regulations. What does that really mean day to day?
It means the rulebook for consolidated returns is thick, incredibly detailed, and frankly pretty confusing sometimes. It covers everything: how you calculate things, track intercompany deals, handle members joining or leaving, allocate income and deductions.
So you basically need specialized expertise just to file correctly.
Pretty much. You're likely looking at higher fees for tax advice and preparation. It's not something you just dabble in. It's a serious compliance undertaking.
Increased cost and needing experts.
Got it.
What else?
The source mentions a potential snag, specifically in the first year you file consolidated. A risk of double counting inventory.
Double counting inventory, how does that happen?
It relates to how you transition from separate filing, especially if there were intercompany inventory transactions before consolidation. The rules try to prevent distortion, but if you don't navigate the initial inventory adjustments just right,
You could end up paying tax twice on some profit or messing up your cost of goods sold.
potentially yes. It's a transition trap you need to be careful about in year one.
Okay, a first-year specific pitfall. Now, we talked about deferring intercompany gains as an advantage.
Right, and the source points out the mirror image can be a disadvantage. Losses on certain intercompany transactions can also be deferred.
So if member A sells an asset to member B at a loss,
That loss might get stuck in deferral, just like a gain would. You don't get to deduct it immediately.
so you lose the immediate tax benefit of that loss, which you might have gotten if you filed separately or sold to an outsider.
Exactly. It could be stuck until B eventually sells the asset outside the group. So deferral cuts both ways. Good for gains, maybe bad for losses you wanted to use now.
Right, delays the benefit. What about operational hurdles? Things the companies actually have to do differently.
A huge one is tax year conformity. The source is very clear. Every single member of the consolidated group must use the same tax year as the common parent corporation.
Everyone has to switch to the parent's year-end, even if they've used a different fiscal year for decades.
Yep, they have to change. That can be a major operational adjustment: systems, reporting, budgeting, all potentially impacted.
Sounds like a pain.
And what if company joins mid-year?
More hassle. The source says if a company joins an existing group partway through the year, it usually has to file a short year tax return covering the period before it joined.
So an extra tax return just for that stub period.
Right. Then it gets included in the consolidated return for the rest of the year. Adds administrative work in the year of acquisition or formation. Okay. Tax year conformity and short year returns. Any other ways consolidation can actually limit tax benefits?
Yes, it's interesting. While it can help optimize deductions limited by income, the source also notes that tax credits can sometimes be less useful in consolidation.
How so?
Well, if the group as a whole has low overall income or even an operating loss due to pooling profitable and unprofitable members,
Then credits that are limited by income tax liability might not be usable even if one specific member generated them.
exactly. The overall group's low tax position could mean there's no tax liability to offset with the credits. So pooling results can sometimes dilute the benefit of credits generated by profitable members.
Okay, another double-edged sword there. Now, this next one sounds pretty serious. Making the election. Is it easy to change your mind later?
This is a really, really critical point. The source stresses that the election to file consolidated is generally binding for future years.
Binding, meaning you're stuck with it.
Pretty much. You can't just decide year to year, separate filing looks better this year, let's switch back. It doesn't work like that.
So how do you stop filing consolidated?
Generally, only two ways, according to the source. Either the affiliated group structure ceases to exist, like the parent sells off subsidiaries, so the ownership test isn't met anymore, Or you get specific permission from the IRS to deconsolidate. And getting IRS permission is reportedly quite difficult.
Wow. So you make this choice, you're likely living with it for the long haul unless the business fundamentally changes. That requires serious long-term thinking.
Absolutely. You need to weigh the pros and cons not just for next year, but for the foreseeable future. And there's one more very practical, often frustrating disadvantage mentioned:
What's that?
the state tax disconnect. The source points out that many states do not allow corporations to file consolidated returns for state income tax purposes, even if they file consolidated federally.
Wait, really? So you go through all the complexity to file one federal return?
And then you might have to turn around and prepare separate state income tax returns for every single member of the group in every state they do business in that doesn't conform to federal consolidation.
Oh, man. That sounds like it could completely wipe out any administrative savings from the federal side. You're doing double the work almost.
It can certainly feel that way. You have to maintain separate state-level calculations, potentially track state-specific adjustments, deal with different apportionment rules for each company. It adds significant time, cost, and complexity to state tax compliance.
That's a huge practical drawback.
Mm-hmm.
Okay, let's recap the negatives then. Super complex rules needing experts, potential inventory traps in year one, deferring potentially useful losses, forcing everyone onto the parent's tax year, sometimes limiting credits, being locked into the decision long-term, and this massive state filing headache.
It's a hefty list. It really underscores that the decision needs careful consideration beyond just the potential tax dollar savings. The compliance burden and loss of flexibility are real costs.
Definitely not a slam dunk decision for every group. Okay, we've covered the landscape, the what, who, why not. Now let's get into the engine room. How do you actually calculate the consolidated taxable income? The source gives a 5-step method and uses that ABC corporation example.
Great. This is where we see how the rules translate into numbers. Remember, A owns 100% of B and C. A is the parent.
Okay, step one.
Step one, start separate. You calculate the taxable income or loss for each member, A, B, and C, just as if they were filing their own separate tax returns. Ignore consolidation for a moment.
Find everyone's individual starting point. The example numbers were A with $836,000 income, B with a $34,000 loss, and C with $274,500 income, right? Before special deductions.
Exactly. Those are their standalone baseline figures.
Got it. Step two.
Step two, adjust for intercompany stuff. Now you go back to those standalone numbers and adjust them to remove the effects of transactions within the group. You want to neutralize internal dealings.
Okay, like those intercompany dividends we talked about. A got $90K from B and C.
Right. That $90,000 dividend income A had in its standalone calculation. It gets backed out here, removed, because it's just money moving inside the group.
Makes sense. What else did the example have? Inventory sales.
Yes. B sold inventory to A and had a $50,000 profit on its books from that sale. Since A hasn't sold it outside the group yet, that $50,000 profit B recognized. Also backed out of B's income, deferred.
Okay, so B's income goes down by $50 for this step.
Correct. And C sold equipment to B for a $10,000 gain, Section 1231 gain. Same logic, internal asset transfer. That $10,000 gain C recognized, backed out of C's income too.
So step two cleans up the internal transactions dividends. Profits on sales between members get removed from the individual calculations.
Precisely. You're stripping out the purely internal noise.
Okay, on to step three. This one sounded a bit odd, removing items that get calculated at the group level.
Yeah, it's about isolating certain items that have specific calculation rules or limitations that only make sense when applied to the group as a whole. So you pull them out of the individual company numbers first.
What kinds of items are we talking about?
The source lists the main ones: capital gains and losses, Section 1231 gains and losses, those asset sales gains losses, NOLs, the charitable contribution deduction, and the dividends received deduction, DRD, for dividends from outside the group.
So in the example, C had made a charitable contribution. It deducted some amount on its standalone calculation. That gets pulled out here.
Yes. C had calculated a $30,500 charitable deduction based on its own income limit. In step three, that $30,500 is added back to C's income, effectively removing the standalone deduction. We'll calculate the group's charitable deduction later.
Okay, remove C's standalone charity deduction. What about A's DRD?
Same idea. A received dividends from B and C, already handled in step two, and $110,000 from an unrelated company it owned 30% of. On its own, A calculated a DRD on all of that. That entire standalone DRD calculation for A gets reversed out in step three.
So we take out the individual attempts at calculating these specific deductions.
Right. We set them aside because they need to be recalculated based on the combined group figures later on.
Which brings us to step 4, combine the adjusted income.
Exactly. Now you take the results for A, B, and C after the Step 2 intercompany adjustments and the Step 3 removals, and you simply add them together.
So A's modified income plus B's modified loss plus C's modified income.
Correct. You sum those preliminary figures for all members. This gives you the group's combined taxable income before you apply those special consolidated adjustments we just set aside. The example table shows this combined figure as $957,000.
$957,000. That's the group's pooled income after cleaning up internal deals and before the group-level deductions.
You got it. That's the base number we work with for the final step.
Step 5. Apply consolidated adjustments. This must be where we bring back those items from Step 3, like the charitable deduction and the DRD, but calculate them using the group's $957,000 number.
Precisely. Now we apply the rules at the consolidated level. Let's take charitable contributions. C actually contributed $40,000.
Right, but can only deduct $30,500 on its own because of its income limit.
But now the limit is based on the group's income. The source indicates the group's relevant income base is that $957,000 figure we got in Step 4. The limit for charitable deductions is 10% of taxable income. So the group's limit is 10% of $957,000, which is $95,700.
And since the actual contribution, $40,000, is less than the group's limit, $95,700.
The entire $40,000 contribution made by C becomes deductible for the group. It's fully utilized, which is better than C could do alone.
That clearly shows the benefit of the group-level calculation. Okay, what about the DRD?
We removed A's standalone DRD in Step 3. Now in Step 5, we calculate the consolidated DRD. This is only based on dividends received from companies outside the group.
Which was that $110,000 A received from the 30% owned company.
Exactly. The intercompany dividends from B and C stay eliminated, so we just look at that $110,000 external dividend. Since A owns 30% of that company, the DRD rate is 65%.
Okay, so 65% of $110,000.
Is $71,500. That's the consolidated DRD.
And that $71,500 is subtracted from the group's income in this final step.
Correct. So you take the combined income from Step 4, $957,000. You then effectively subtract the consolidated charitable deduction, $40,000, and subtract the consolidated DRD, $71,500. The example table shows the final result.
It shows $845,500 as the final consolidated taxable income.
Exactly. That's the number the group pays tax on. It's the result of that whole process. Start separate, adjust internal, pull out group items, combine, then reapply group items based on combined figures.
But walkthrough makes the mechanics much clearer. It's complex, but there's a definite logic flow to it.
There is. It's designed ultimately to tax the group as if it were a single entity, reflecting its combined economic activity with the outside world.
Okay, calculation covered. What about just the practical filing stuff? Any other key compliance details from the source material we need to know?
Yes, a few important administrative points. Filing itself, you use the regular corporate tax form, Form 1120.
The same one everyone else uses.
Yep, but there's a specific box you check on page 1 to say this is a consolidated return. That checkbox signals everything else that follows.
And I assume checking that box means you have to attach a lot more paperwork.
Oh, absolutely. You need detailed supporting schedules showing each member's contribution, all those intercompany adjustments, the consolidated calculations, full transparency on how you got to that final number.
Documentation is key. What about accounting methods? If companies use different methods before joining, do they all have to switch?
Generally, no. The source suggests members can usually keep their existing overall methods, like cash or accrual.
Oh, okay. That's helpful.
But there's a catch for certain methods that have eligibility thresholds, often based on gross receipts, like maybe the cash method eligibility for larger C-Corp. For those, the test is applied based on the consolidated group's aggregate numbers.
So a small subsidiary might get kicked off the cash method if the group as a whole is too big.
That's the potential issue, yes. Group attributes can override individual member eligibility for certain specific methods.
Got it. And we keep mentioning the tax year.
Yes, the source reiterates it as a strict compliance rule. Every member must adopt the parent's tax year. Non-negotiable.
Forced conformity there. Now, liability, you mentioned this earlier, but the source brings it up again under compliance.
It does, and it's worth stressing because the implications are huge. It's called joint and several liability.
Okay, break that down again.
Yep.
What does joint and several mean in this context?
It means every single corporation that was part of the consolidated group for a tax year is legally responsible for the entire tax bill for that year, including penalties and interest, not just their share, the whole thing.
The whole thing.
Hmm.
So the IRS could come after a small, maybe even loss-making subsidiary for the entire group's unpaid tax debt.
Yes. If the group owes money and doesn't pay, the IRS can collect the full amount from any member it chooses, regardless of that specific member's individual profitability or contribution to the tax liability.
Wow. That really binds the face of these companies together.
Yeah.
One company's failure to pay puts everyone else on the hook.
It's a significant risk that every member takes on by being part of the group. Requires a lot of trust and usually internal agreements about how taxes will be funded and allocated.
Definitely something to have clear agreements on internally. Okay, one last compliance point. Estimated taxes, how do those work?
There's a bit of a transition rule. For the first 2 years, a group files consolidated. They have a choice. They can calculate and pay estimated taxes, either based on each member's separate liability or on a consolidated basis.
So some flexibility initially.
Right. But starting with the third consolidated return year, that flexibility goes away. From year 3 onwards, estimated taxes must be figured out and paid on a consolidated basis.
Okay, so you have to get your consolidated estimating process sorted out by year 3.
Correct. It brings the estimated payments in line with the final return filing method.
All right, well, that covers a lot of ground. We've gone from the basic concept, this privilege of filing consolidated, through defining who qualifies, like that crucial corporate parent requirement and the 80/80 test.
And who doesn't? Like S-Corp, Foreign Corp, and those brother-sister setups.
Right. Then we weighed the really attractive advantages, offsetting losses, killing the tax on intercompany dividends, optimizing deductions, deferring gains.
Against those very real disadvantages, the complexity, the binding election, tax year changes, deferred losses, state filing nightmares, and that big one, joint and several liability.
And we walked step by step through the calculation, seeing how you move from separate income, adjust for internal deals, isolate group items, combine, and then apply the group-level rules to get that final consolidated taxable income figure.
It really paints a picture of a powerful but demanding tax regime. It offers efficiencies but requires significant investment in compliance and careful strategic thought.
It absolutely does. A privilege that comes with serious responsibilities and risks. Which leaves us with a final thought for you, the listener, to consider. Given everything we've unpacked, the clear, often substantial tax savings from things like loss offsetting and dividend elimination on one side versus the heavy weight of regulatory complexity, the inflexibility being locked in, the administrative drain, especially with state taxes, and the profound risk of every member being liable for the whole group's tax debt on the other side. How does a company or group of companies really make that call? How do they weigh those tangible dollar benefits against the less tangible but potentially massive burdens and risks to decide if exercising this privilege is truly the right strategic move for their specific situation, not just for next year, but for the long run?